When a corporation generates more cash than it consumes, it must eventually decide how to return that value to its owners. This surplus, the free cash flow, is the primary driver of shareholder returns and long-term corporate strength. Most investors measure these distributions through a single, traditionally accepted metric, the dividend yield. However, looking strictly at dividend checks creates a narrow view of financial health, ignoring two other methods companies use to distribute their wealth. The first missing indicator is the net share buyback. By repurchasing its own stock, a company reduces the total number of shares in circulation. This increases the value for remaining shareholders without triggering the immediate taxable event associated with a dividend payment. The second missing indicator is net debt reduction. Using cash to pay down liabilities strengthens the balance sheet and reduces future interest expenses, though this value rarely appears on a standard yield chart. Combining these three factors, cash dividends, net share repurchases, and net debt reduction, results in a metric called shareholder yield. It is a measurement of the totality of a company's cash returns. Judging a company solely by its dividend yield captures only a fraction of its actual distribution, leaving a significant portion of its total yield hidden from the average investor. Identifying these companies globally requires a massive starting universe of publicly listed firms in developed foreign markets, specifically excluding the United States. The Cambria Foreign Shareholder Yield ETF, or FYLD, acts as a mechanical filter designed to isolate the most efficient cash generators in these regions. The process begins by isolating the top 20% of these stocks based on the combined rank of their dividend payments and net share buybacks. This pool passes through a valuation ensemble. The algorithm screens for stocks trading below intrinsic value by analyzing price to book, sales, earnings, and enterprise value to EBITDA. It also filters for quality, rejecting highly leveraged companies using excessive debt to sustain payouts. The model performs a final sort using momentum and trend indicators, aiming to position the portfolio in stocks showing the strongest current price performance. The result is a portfolio of 100 stocks, targeting an equal weighting across the holdings, with the entire group rebalanced on a quarterly basis. This multi-layered process distills a vast global index into a highly concentrated portfolio of companies that meet specific cash flow and valuation requirements. By following this shareholder yield architecture, the fund develops a structural profile that differs significantly from passive benchmarks, like the MSCI EAFE index. Visible in sector allocations, the portfolio carries a 35.1% concentration in energy, while the standard benchmark allocates just 4.4%. A similar tilt exists in financials at 19.1%. Historically, these two sectors are significant generators of free cash flow. These filters result in distinct valuation metrics. The fund's price-to-earnings ratio of 13.45 is notably lower than the index's 17.79, and its price-to-cash flow ratio sits at nearly half that at the benchmark. Operationally, the fund maintains a net advisory fee of 0.59% and currently provides a 30-day SEC yield of 3.55%. Prioritizing total cash returns shifts the portfolio's center of gravity away from market cap weighting, creating a strategy defined by deep valuation discounts. This highly concentrated strategy navigates directly into the unpredictable and high volatility of international markets across the globe. The potential benefits are clear. The model systematically targets cash-rich international firms while utilizing buybacks to return value without immediate dividend taxes. But investors must also consider the risks. High-yielding stocks can occasionally become value traps, where a company pays out more than its operations can support before eventually cutting the dividend. The portfolio's heavy concentration in energy, over a third of the total assets, leaves it highly susceptible to commodity price shocks and sector-specific downturns. Additionally, international exposure introduces risks that domestic investors don't face, such as currency fluctuations, varying accounting standards, and geopolitical instability. The algorithmic pursuit of shareholder yield creates a strategy that can magnify both the potential for income and the risk of significant drawdowns. The central question for investors is whether this broad view of cash returns is a more effective way to capture value than traditional dividend investing. By looking past the dividend alone, This model attempts to track the total, uncamouflaged cash return a company provides to its shareholders. FYLD is built for a specific thesis that global value and free cash flow are better indicators of portfolio weight than a company's total market capitalization. Does this shareholder yield approach belong in your portfolio? Share your thoughts in the comments and subscribe to keep up with our latest analysis of global investment strategies. This video is for educational purposes only and does not constitute financial advice. Past performance is no guarantee of future results, and all investments involve risk of loss.